Happy New Year, everybody. Welcome to yet another SEM Economic Update. My name is Jeff Hybiak. I'm the Senior Portfolio Manager for Strategic Equity Management. And today is January 9th, 2012. What we're going to look at is what happened in 2011, and we're going to focus on some of the key events throughout the year. And then we're going to use that to look ahead at what 2012 may bring. Before we move on, let's get a quick little disclaimer out of the way. If you want to find out more information about strategic equity and any of our programs, we encourage you to call our office at the number listed there on the page. We also want you to contact your financial advisor and consider your investment objectives, risks, all charges and expenses carefully before you invest. We would encourage you to take a look at our Form ADV Part 2, which is available upon request. It's also available on our website. Please understand that all the information provided here is intended to be general of nature and should not be construed as investment advice. SEM is a registered investment advisor. You can find out more information on that on the SEC website. 2011 was certainly an eventful year. I was really surprised when I took a look at some of the headlines for the year to realize just how many big things happened in just one single calendar year. The year got started off on a very tragic note with the shooting of Congresswoman Gabrielle Giffords and many other people in that Safeway Plaza here in Tucson. Shortly thereafter, we had the Arab Spring, as they began to call it, really take center stage as they went through a revolution in Egypt. We then, in March, had the tsunamis that hit Japan, followed by the nuclear meltdown. We did capture and kill Osama bin Laden. We had the debt ceiling. We had the U.S. losing our AAA rating. We had more riots in Greece and Italy and Spain. We, of course, had to deal with Europe for the most of the year, beginning in May, and I think it carried on all the way till New Year's Eve. And then we had what I think was a pretty major event, which was the Occupy Wall Street movement, as we saw some people start to be very outspoken about some of the disparities that we see in our economic environment. Let's take a look at how some of those key events impacted the stock market. One thing you have to do when you take a step back and you realize how difficult investing is you have to invest on what we call the hard right edge. And what we're going to try to illustrate here is just how you don't know what the future may hold. Everybody likes to say they are confident in what the outcome's going to be. I'd like to say that we have 100% certainty whenever we make a decision, but the fact of the matter is you have to invest on that hard right edge. So let's take a look at 12 distinct periods that happened in 2011. The year got started on a very strong note, 0.6% in the first 34 trading days. And if you remember back as we ended 2010, there was a lot of optimism about economic growth. We had the Social Security payroll tax cut go into effect, where people were expecting that to add at least 1% to GDP growth, as well as continued easy money policies from the Federal Reserve, and just a lot of positive things happening in the economy. However, as we mentioned before, that Arab Spring that began in February really knocked the market down. You could see it lost 6.4% in 17 trading days. And it took the market to be negative for the year by the time that ended. And it actually bottomed when we had the Japanese earthquake, tsunami, and the nuclear meltdown. We saw an almost unexplainable rally from March 17th through April 29th, 8.5% in 31 trading days, as big investors kind of bought the dip. They saw the bad news that kept hitting, and they just figured that, hey, everything's gotten pretty negative. We still have this positive economic growth happening. And we saw Congress come up with some, what at the time they called record spending cuts, $39 billion off of the annual budget, and the market had a pretty nice rally up till April 29th. Little did we know, when you see that, you look at the rally and you think, wow, that was pretty encouraging. April 29th marked the very highest point the market would hit the rest of the year. As we moved into the beginning of May, remember, we had a lot of inflation taking hold. We saw the price of oil skyrocket throughout the spring. We saw that starting to hit gasoline and food and everything that we buy at the grocery store and at the mall started going up in price. And that's when the term transitory slowdown was born, and they said, well, this is just temporary. Well, the market didn't look at it like that. Remember, we started the year with optimism towards economic growth, and now all of a sudden we had inflation causing concerns, and then once again, just like in 2010, we saw European problems pop up that was really starting to impact the psyche of investors. However, just like in 2010, once a bailout hit, the market rallied. So from June 16th to July 7th, the market rallied almost 7% in 15 trading days. So that's about 3 weeks. As Greece made some promises that they would make some spending cuts and some layoffs and some pension reforms, and then all of a sudden, the market's able to rally. But that was soon followed by what I called the debt ceiling circus. You could see from July 8th to August 8th, 1 month, 22 trading days, the market lost 17.3%. If you'll remember, there was talk about the U.S. defaulting on its debt. There was talk about the government shutting down, a whole lot of fear-mongering going on. But the main thing that was highlighted during that time was how broken the political process was in our country. And things looked pretty bleak, and it ended on August 8th when the U.S. was downgraded by S&P from AAA. Then we went into the brutal dog days of August, and that turned into the dog days of September, and it was just a pretty rough time, 39 trading days, where over half of those days had a 2% swing from the high of the day to the low of the day. And in the long run, the market really, I think it lost about 1% over those 39 trading days. But it was just a brutal time period. There was a lot of angst as far as the debt problems happening both in the U.S. and in Europe. And it was just a very miserable time. You could see how those wild swings happened almost on a weekly basis. We'd have 1 week up, 1 week down. And it caused a lot of concern and a lot of problems for active money managers like us. The very difficult period was finally broken October 4th when a rumor broke out that they were going to come up with a way to finance all of Europe's bad banks. They were going to be able to recapitalize them. They were going to fix the government debt problems in Europe. And throughout October, we got a few details here and there about it, but the market, after having all that volatility in August and September, just took off. It rallied 17% in 18 trading days. To put that in perspective, the market has only moved that quickly 6 times in the last 60 years. Almost all of those occurred inside of a bear market. And what you see happening is similar to what we saw in 2011, was that volatility and concern that everybody had about the future prospects of the market and the economy led to what we call a short covering rally, because everybody starts betting that things are going to go down and go down severely, and so they start placing bets on that, trying to make money on the downside. And then when something like this rumor happens, they start to say, well, maybe my thesis is wrong, and they have to buy back all the stocks that they had shorted, betting on the downside. So then you get this big rally, and really, people start calling it the bazooka. They called it European TARP. If you remember back in 2008, the market had a pretty big rally in the U.S. when TARP was announced, well into December, before once again reality set in early 2009. And so this bazooka comes out on October 27th, and you think, well, the market will keep going now that we see details of it. Unfortunately, from October 28th to November 25th, the market lost almost 10% in just 20 trading days, because they realized it's probably too late to save some of these European countries. They also noticed that this big plan that they had supposedly been working on for over a month really wasn't a plan at all, except that they said we're going to come up with a plan. They didn't have any details, and the market sold off because of the lack of details. But right after Thanksgiving, we saw an interesting thing happen where the market popped back up. It gained almost everything it lost in just 8 trading days. Again, you can just see the volatility in the market in 2011. These are something, if you have a weak stomach, you really didn't want to watch. And what happened was the EU leaders agreed, hey, we're going to have another summit to talk about these details, and we're really going to work it out this time. Plus, you had the Federal Reserve coordinate with the other central banks to basically increase liquidity in the financial markets by agreeing to some electronic swap mechanisms back and forth between all the different banks, so that if credit did become tight, they figured that the central banks would be able to take care of that. Unfortunately, that enthusiasm was met by an almost 4% sell-off in 1 week, because the details of the latest EU summit came out, and once again they were short on details. They just still could not come up with a plan on how to deal with everything. But then the year ended, we saw Congress come together and extend the payroll tax cut as well as unemployment benefits. The ECB, which is the central bank in Europe, came out and announced a funding plan for some of the struggling banks over there, and the market ended up 3.8%. When it was all said and done, the market ended up basically where it started. I think it was 0.04 points start to finish. But you see these wild swings, and it's just, it was one of those years where it would have been nice to know ahead of time that it was going to be like this, because you would have just parked it in cash, done nothing, and just enjoyed your year. Maybe taken a sabbatical if you're an active money manager or whatnot. But we don't know that. Remember, we invest on that hard right edge, and that's something that's really important to understand, because on the plus side, I really do believe deep down that this could be a great year for the market, and there's several reasons why. Number one is this economic recovery could pick up steam. We saw some really strong numbers come out late in the fourth quarter: retail sales, consumer spending, housing. A lot of positive things were happening with the economy, and if it picks up steam, we could see a nice year for the market. Another thing is we could see no surprises out of Washington this year, and that's namely because it's an election year and nobody really wants to tick off the businesses or taxpayers in this election year. We also could see the trend continue with strong earnings growth, and we're pretty much guaranteed that we're going to continue to see easy money policies out of the Fed. And what that means is they're going to keep interest rates low, they're going to continue making extra money available when necessary. And one thing that the market has in its favor is the composition of the voting members of the Federal Reserve Board changed in January 2012, so that, and this wasn't some conspiracy, it's just something that the three of the members who have kind of been holding back Fed policy because they're afraid of inflation were replaced as scheduled. Each person's able to vote for about 2 years, and then it's a constantly revolving term as far as their voting goes. But they were replaced by three people who believe it's the Fed's job during a crisis and during a recession to make money easier. So at a minimum, we're going to see a status quo as far as the Fed goes, and we possibly could see some more quantitative easing coming out of the Fed, which over the short run could be a great thing for the market. Finally, on the positive side, we could finally see European leaders implement some long-term structural reforms rather than just the band-aids that we've been seeing happening over the last 2 years. Now that's the positive side. On the downside, and a reason we caution everybody to not be too optimistic and too bullish in their investments, is there's a lot of things that could hit the market pretty hard. And the first and foremost is I've seen a lot of overly optimistic expectations. Most analysts out there have the same target prices for the market that they had for 2011, which was about a 10 to 15% growth in the market. And the reason I have this on the down, on the negative column, is because if everybody is already optimistic, who is left to buy stocks? People have probably already positioned their money based on these expectations. You got to have some balance. You got to have an equal number of people bullish as there are bearish if you want to have some sort of potential for an outperforming type year. As I mentioned earlier, it's probably too late to save some of these European countries and many of the banks that are exposed to that, which could then begin to hit some of the Wall Street banks here in the U.S. The downside to the easy money policies, which could also cause a tough year just like it did in 2011, is that when you create too much money, you could have runaway inflation, and that hurts the people right on the fringe. You know, the Occupy Wall Street movement talked about, oh, we are the 99%. Well, that 99%, you know, whether you believe that number or not, is hurt more by an increase in inflation than somebody who's making over $1 million. We also know that because of the gridlock in Washington, we aren't going to have any more fiscal stimulus from Congress. Plus, we have to realize there's going to be a lot of uncertainty as we go into the back half of the year on tax rates. Not only will the payroll tax cut that was extended for a couple months, and they hope to extend all the way till the end of 2012, not only will that end, you have the Bush tax cuts that are going to be expiring at the end of the year. Plus, remember the whole debt ceiling compromise that they made. Those huge cuts in government spending come into play the very beginning of 2013, and there's a lot of rumblings already about ways that they can maybe not cut defense so high, or maybe there's a way they could raise taxes, and all sorts of different things. Plus, you have the debt ceiling. The way they extended it, it may not last until 2013. They may run into that before then. And then that brings us to the final point of why I think 2012 could be a tough year is this election rhetoric is getting very ugly. And as the year carries on, it could get even worse. And one thing that I've seen over the last 3 or 4 years is whenever you have Washington bashing Wall Street, the market struggles. And so many people of the voters are anti-Wall Street that we could see a lot of ugly rhetoric coming from there. So it's something to watch. On balance, it could be another year like 2011 where there's a lot of ups and downs and we really don't go anywhere. Or you could see it swing one way or the other, and you could have a phenomenal year on the upside, or you could have a devastating year on the downside. It's just too soon to tell. There's too many unresolved issues to just blindly buy the market right now and think it's going to be good, or to, you know, quite frankly, to get out and try to make money on the downside. It's too dangerous right now to do either one. You know, to steal a phrase from the 90s, it really is the economy, stupid. It's another election year, and we're probably going to have to deal with a lot of that, and it's all going to be about the economy. I think the market's ability to not implode in 2011 was partially due to the fact that the economy did begin to get better. If you remember, throughout most of the summer, people thought we were heading into a recession. In the last economic update we did at the beginning of October, we told people, said, look, this is not a double dip yet. And so far we've been proven right. The economy is getting better. So what I thought we'd do now, because this is going to be so important in 2012, is take a step back and let's look at some of the leading recovery indicators that we have found have a very good track record of predicting which way the economy is going. Here's our top indicators, along with their current trend according to our models, as well as how they've been performing over the last 12 months. And just understand that these leading indicators help us to focus on areas that could be important as we move through 2012. Net right now, our indicators are pointing to about a 2 to 3% growth rate that's happening in the economy, which is pretty good. It's not spectacular, but it's a lot better than a double dip like some people were talking about just 3 months ago. On the surface, I'm asking, can housing save the economy? It looks like, well, gosh, I don't think so. It's really going to remain a drag on the economy. It's kind of muddling through. And to put this in perspective, this chart only goes back to 1990, but if you were to go back to 1947, this would be at the lowest level of activity during those past 60 years. So it doesn't look good right here on the surface, but when you jump ahead and look at just the growth rate year over year, you start to see some encouraging signs. Now keep in mind that the economy is measured against where it was at the prior period. So when you see growth in housing activity, that means it's going to have a positive influence on where the economy was and where it's going. It doesn't matter that this number is so low. The fact is it is growing, and that's a positive thing for our economy. One thing that I am encouraged by is, for our longtime followers of strategic equity, you'll remember we were very early in calling the housing bubble. We started talking about it in 2006, even though nobody really wanted to listen to us. And one thing we kept pointing out back then was the trend. If you go all the way back to 1960 and draw a trend line of building permits, which is the level of activity taking place in the housing market, you could see where the bubble began in 2003. And it just was going at such an unsustainable pace. Remember, population wasn't growing that fast. And it's needed to get back to the trend. Well, what's encouraging is, just as we predicted, by now that we're in 2012, we're finally back to that trend line. Now that doesn't mean it can't go lower, but what it does mean is that the excess has finally been worked off through the function of time. We still have a lot more inventory out there as far as already built homes, but the excess has been gone. That's why we're starting to see growth in building permits, and something that is encouraging for the economy. And one reason I like to watch this number as far as where it goes in the economy is, traditionally, housing starts, which is the measure of when ground is actually broken from all those permits that were issued, they tend to pull the economy either up or down. I zoomed in on this chart just so we could really focus in on the fact that, in general, the direction of housing activity is the direction the economy ends up going. So you got to step back and you got to think of, why does this occur? And you just think of all the economic activity that's surrounded when somebody breaks ground on a house. Think of the jobs that are created when a new unit is started. Think of all the materials that are used and the businesses that supply those materials, and then the people those businesses employ. And then especially think about, after somebody moves into a new house, you got the furniture and the appliances that everybody has to buy, window coverings to purchase, and then of course landscaping to put in. The only downer I see when I look at this number, remember, building permits have climbed at a 25% annual rate. We saw housing starts climbing at a pretty big clip as well. However, almost all of that activity is in the multifamily area. You know, multifamily is things like apartments, townhomes, condos, duplexes, etc. Single family housing starts are basically flat. So that tells us there's still a lot of excess inventory in the single family space. And if you remember back in the housing bubble, a lot of these multifamily places were converted to single family, or they were, the rentals were converted to ownership type things. Apartments became condos and they were sold. So we had a real lack of rental properties available, and all those people that bought in the bubble that probably shouldn't have are having to go back to renting. So we're still going to see maybe not spectacular GDP growth because of this number, but it is something that is rather encouraging, and it could also turn around something that is one of my biggest concerns for the economy going forward, and that's consumer sentiment. It is certainly a dark cloud, and you could see that since 2000, people have kind of been depressed as far as their outlook on the economy and the markets, and it still is quite low. And you have to realize consumer spending represents 70% of the U.S. economy. However, we have seen one thing that could show that sentiment is going to change, and that's when you start looking at consumer credit. You could see that consumer credit really fell rapidly during the recession. This chart is measuring the percent change from 1 year ago, and you could see it has started to grow pretty rapidly. However, it does help us to put the spending growth we've seen in perspective. Let's look at this number. Consumer spending grew at a 4.3% rate in 2011. Pretty good number. But 2.4% growth in consumer credit tells us that most people were at least with half of that borrowing in order to spend more money. And then take a look at another statistic. The savings rate fell by a 1.7% rate in 2011 down to 3.5%. What that means is people are now only saving 3.5% of their take-home income. So you take the spending minus the credit growth minus the savings reduction, and you get down to just 0.2% real spending growth. So not really that great, and my biggest concern is that people haven't learned their lesson. Remember, during the bubble, they used debt to buy everything, and then we saw the debt pull back, and I thought, well, good, people are starting to realize we can't keep using debt to finance our standard of living. And we also saw the savings rate pick up quite a bit during the recession, but now that's coming back down. So that is something we're going to have to keep an eye on to see how sustainable the growth is going to be for our economy. One thing we saw with the December jobs report is jobs are increasing. They're not going that fast, but they are starting to increase. And that could definitely have an impact on consumer confidence, consumer spending, and things like that. The issue is, though, we have a really long way to go. If just the 200,000 pace that we saw in December 2011 continues, it's still going to be June 2014 before we get back to the number we were at in 2007. So 7 years to recover all the jobs that are lost. That's a very slow rate of recovery. And it does point to some of the structural issues that we could have in our economy. And it's one thing that does make me more cautious on the 2012 outlook, because we got to figure out how to replace some of these jobs that were lost and help get these people that have been unemployed for a very long time. The average unemployment duration is now 40 weeks, almost an entire year on average if you're unemployed. That's something that our economy has to figure out how to fix. Now, let's move on to really figure out what can go wrong in 2012. To really understand both what happened in 2011 and what the future may hold for 2012, we need to gain a better understanding of economics. Economics, quite simply, is just the study of how society allocates scarce resources and goods. Resources are inputs that society uses to produce outputs. Some of those examples include labor, capital, which would include money, equipment, and land. Now the goods in that equation are the products produced by the economy. Some of those examples are food, clothing, housing, cars, whatever you want to buy, as well as services such as your barber, doctors, police officers, dentists, investment advisors, whatever it is. Goods include all services inside of an economy. So let's look at Economics 101, just a simple economic model. Now in each of these models that we show, the green line is the capital, the money flow, whereas the purple line there is something that is being given or produced. So let's look at individuals. A business hires an individual. So that individual is giving the business their resource of labor, while the business in turn pays for the resource with the money. Now a business then generates a good or a service. They sell it to the individuals and they get money in return. So in a perfectly balanced world, this would be good enough for the individuals, and the businesses could regulate each other. You'd see some balance. You would see everything functioning properly. But of course, the world isn't that simple, and we all know the world is not perfect. So let's move to Economics 201. And that's where we get the government involved. And most people consider this a better economic model because, unfortunately, human nature has been that we haven't been good at regulating everything. And you do need the government to stand in and fulfill some things like defense or, well, maybe defense. I'm trying to think of anything else that the government can provide. There's some regulations that have been good. Obviously, civil rights and things like that, where they've stood to protect the little guy, the government does need to play a role. So when you add the government into this model, obviously they have to be funded somehow. So they're going to have to take in money. And then the government turns around and they actually give out money, whether it's tax credits, subsidies, or just outright direct payments to both businesses and individuals. And then of course you have the government also buying goods and services from the business. And on the other side, on the left there, they employ individuals. And so that really adds some complexity to the economic model, because it's no longer just between individuals and businesses. You have the government in between there, but you still have the businesses and individuals doing business directly with each other. Now, if the flow of funds inside of the government, if all those green arrows were equal and balanced, this model would work great, and we could stop with our Economics 201 lesson. However, let's move on to government economics, our 301 class. Now here is basically what our current economic model looks like, and you could see the problem right there. It's the center of the screen. Those arrows coming out of the government, which again the green is cash, they're too big. It's not balanced off by the money coming in to the government. Now we could also make things bigger as far as how many resources the government's employing versus how much they're paying. We don't have time to go into all of that. How much the government actually pays for goods and what they're truly getting in return. We've seen a lot of the audits that are done by the CBO, and we know that the government is not very efficient. But to keep things simple for this 301 class, we have to understand that because the government for 30 years has not balanced the payments between what they're taking in and what they're paying out, it doesn't work anymore. Now, many academics in this field believe that this imbalance is necessary during economic contractions, because they believe that the government can then make up for the imbalance by reversing it, by having more money coming in than going out during the years of economic expansion. But the problem is, for 30 years, this hasn't been the case. And so now that means we're going to have to move on to advanced economics. This is our highest level class that we offer here at Strategic Equity. And it is a 401 class, but we have to keep in mind some things. In our 401 class, we're going to study how to pay for this economic imbalance that was created when the government began interfering with our simple economic model. Now, some of the prerequisites: we cannot accept anybody in this class that got anything above a D in Economics 101 and 201. Also, if you want to get into our 401 class, you have to have passed Economics 301. That's the one that includes the government imbalance, with an A+. Anybody with a GPA of 2.0 or lower in all math classes are the only ones we'll consider letting into this 401 class. Honors students certainly cannot take this advanced economics class. You also must have completed 12 credit hours of creative thinking courses, because we're going to have to really expand our brains to figure out how to take care of this imbalance. And although not required, we do recommend a beard. If you've seen a picture of the Fed Chairman Ben Bernanke, he has a very nice beard. And I think to really understand advanced economics, it helps to have a beard, although it's not going to be required. And furthermore, we must warn you, if you bring a calculator to this course, you will receive a failing grade. So let's take a look at advanced economics. Now remember, our government has created an imbalance because they chose not to get back to equilibrium by either increasing the income or reducing the expenses during the good times. So now our closed system that we had that was working rather well has to be opened up to outside parties. Now, the first thing we have to worry about is how to fund our government. So we're going to fund this imbalance by getting money from these outside investors via treasury bonds. And you could see those outside investors are going to receive treasury bonds issued by us, and they're going to give us money so that our government can function. The problem is we're going to have to pay out interest on those. So now the money no longer stays completely inside of our closed economy. It's going to outside sources. Now, because of the issue of time, we're not going to be able to talk about some of these other imbalances. That's for our 402 class. If you also realize that this closed system doesn't work any longer because the United States is running a trade imbalance where we import far more than we export. So you all of a sudden have individuals, you could just replace treasury bonds with foreign goods and services, and outside investors with outside countries like China especially. And so we have a lot of money flowing out to China in return for goods and services that may not be the best quality. But that again is for our 402 class. So keep this in mind now as we look at a real life example of our current global economic system. Here you go. Now, the United States government box, that blue and red one there, down here on the bottom, this is how complex it gets when we have to come up with funding. And now remember, this model is not perfect, and once again I must caution you, you cannot use a calculator in this course to fully understand it. And I'm just going to leave it up there for a little bit. On our blog, we have an article called The Global Financial System where we detail some of this stuff. I would encourage you, if you want to look at this further, we include this in a JPEG format so you can download it and view it yourself. It's something that we all have to understand, that there's no easy answers anymore. The money flowing back and forth, just trying to keep our financial system going is just unbelievable. And so whenever you hear about a solution to the financial crisis in Europe, you got to look back at this flowchart and realize where the money's coming from. Because almost every country in the world is heavily indebted, and they're borrowing money from each other, and it just doesn't work anymore. At some point, they're going to run out of money. Now we see off to the right, a lot of the central banks have turned to Uranus. I'm sorry, excuse me, I guess the pronunciation now is Uranus. But when I was in school, we called it Uranus. And that appears to be where the central banks are getting the money. And not included in this flowchart is something we have to go back to 2011 to remember, is when the central banks turn to Uranus to help keep this system going, it causes unforeseen circumstances, excuse me. And one of those circumstances is inflation. And it creates things like we saw in the Occupy Wall Street movement, because the Federal Reserve then turns around and gives money to the US banks, and they give it to the EU banks, and they give it to the European Central Bank. And everybody who has to pay for it, those living paycheck to paycheck, or the taxpayers, they're the ones that bear the real burden of this global financial system. So it's definitely a broken system, but it's something that only those that don't use calculators, only those who have passed this advanced economics course truly understand. So if you don't understand it, you probably got an A or a B in math. You probably know how to work a calculator. So, you know, for that, I apologize. You know, you people that can think for yourself will never get an A in advanced economics. Now let's move on to another course of ours, and that's the European economics. And again, we have this on our blog at stratequity.com, and it's an article called The Debt Ponzi Scheme. And this again shows the complexity of our global financial system, but let's just simplify it, and let's take a look at the actual money that's being lent back and forth inside the European Union. Let's start with, you know, off sort of in the middle of the page and look at Italy. They've been making a lot of headlines recently, and notice the purple box in Italy. That's how much money Italy has borrowed from France. So now let's jump off to the far right and look at France. Now, not only has France borrowed a little bit of money from Italy, look at some of these other purple boxes and the countries that France has lent money to. We have Spain, who of course is struggling to make payments on their debt. We have Portugal, who's already had to be bailed out. Still have Italy. We have Ireland, who's also needed bailed out, and Greece. And France has even lent money to Germany. But for this illustration, let's just stick with the fact that France has lent money to Greece, Ireland, Italy, Portugal, and Spain. Now, that at some point is going to cause a problem for France. So who has France borrowed money from? You could see the United States is one of the biggest lenders to France, if you go all the way to the left there. You could see that, you know, we have Germany has again lent money to France. And then of course you have the United Kingdom again lending money to France. So now let's go over to the left side of the page and look at the United States and the United Kingdom. And you could see the money going back and forth between the US and the UK. You could see that Germany is one of the primary people lending money to both of those countries. So to me, this is the definition of a Ponzi scheme, because you just have money floating around, going back and forth. It's paper money going between countries, but eventually, as one country has a problem, it's going to filter to the next country, and so on and so forth. Now, to look at a different way, let's look at the money that has been loaned to the EU members by each of the different countries. You could see that the United States and the United Kingdom only trails France as far as the amount of euros that they have lent to the EU members. But then let's go over to the right side of the graph there, and let's look at how much we borrowed from the EU members. So if you think about it, when the EU members have problems, they're not going to be able to buy bonds from other countries. And you could see that the US and the UK have relied very heavily on borrowing from the EU countries, to the extent that both countries risk losing a major source of funding for our broken financial system if the problems continue in the European Union. So that's why Europe matters, and that's the one thing that could really screw up 2012, is if we see the ability for the US to borrow from the European Union, and we start to see losses in the US banking system from all these loans to the EU members, all this recovery that we've been focusing on in the first half of this presentation is gone. Because in this broken financial system, it's no longer closed. Everything is connected, and it's, again, my definition of a Ponzi scheme, and it's something that must be fixed. Now, we've all seen this chart before, and it is something that I want to close with once again. It shows the 18-year cycles. I first identified what I thought was just a mathematical coincidence that about every 18 years you have a good period followed by an 18-year bad period in the market. But I started studying the generational cycles and noticing that it really lines up with about the amount of time that each generation has to influence the market and the economy. And we've seen a lot of different cycles over the years. You go from an inner-driven market like we saw in the 1910s and 1920s, that's followed by a crisis. Coming out of the crisis, we see an outer-driven society where everybody's focused on making society better, followed by a social awakening. The 60s and 70s was certainly a social awakening, and it's the violence and the uprising and everything happened caused a real difficult time for the market. And then you're back to the inner-driven period. The 80s and 90s were certainly very similar to the 1910s and 1920s as far as everybody was focused on themselves, regardless of the consequences it had on society. And that puts us right back to where we are now, which is a crisis. So whatever 2012 may bring, I don't think we're quite out of the woods yet. I think we have to pay for all the debts, and you can't just magically make them disappear. it could be a good year for the market, but it doesn't mean that we're out of the woods yet. So I hope that everybody is going into 2012 with some caution. I hope that everybody is really careful with how they're allocating their investments. Now, we've covered a lot of things in this presentation today. I've mentioned our blog a few times. I would once again encourage people to go to our website. You can register for free if you go to stratequity.com, click on professionals, and I write an almost daily blog where I'm going through the different issues that are being handled by the market at that time. We walk through 2011 every day, going through what's moving the market, and so I'd encourage you to check it out. I hope everybody found this presentation useful. Once again, we're trying to commit to doing this once a quarter. We want to give everybody a good feeling of where we see the economy heading, and I thank everybody for joining us.